Hey friends, welcome back to the channel. I'm Iggy from the Investing Iguana, where we dive into everything from stocks and finance to retirement planning and wealth building strategies. Super excited that we've been ranked 8th in the 2024 Influential Tigers by Tiger Brokers. With over 768,000 reads and 53,000 likes, plus more than 700 videos and 300,000 watch hours, as of December 2024, I'm humbled by your support. Today, we're tackling something major that's shaking up the markets. Whoa! Did you see what happened to tech stocks yesterday? The Nasdaq just experienced a massive $1 trillion wipeout. That's not a typo, trillion with a T. Let's break down what happened, why it matters, and what it might mean for your investments. On Monday, we witnessed one of the worst trading days in recent memory, with tech stocks taking the hardest hit. The tech-heavy Nasdaq 100 plunged 3.8%. Its biggest single-day drop since October 2022. At its lowest point during the day, the index was down 4.7%, wiping out more than $1 trillion in market value. That's like erasing the entire value of companies like Meta or Amazon in a single day. Think about it this way. If you had $100,000 invested in a Nasdaq index fund, you would have lost $3,800 in just one day. That's enough to make anyone's stomach churn, right? But what's behind this massive sell-off? Well, it's not just one thing. It's a perfect storm of problems hitting the market all at once. We're seeing uncertainty around tariffs, weakening confidence in AI spending, which has been driving a lot of the tech rally, and disappointing inflation and labor data. It's like the market was walking on a tightrope, and suddenly the wind picked up from multiple directions. Adding fuel to the fire, there's growing anxiety that the US might be heading into a recession. President Trump didn't help matters when he refused to dismiss this possibility over the weekend. When the president doesn't rule out a recession, investors get nervous, and nervous investors sell stocks. Remember the Magnificent Seven stocks we've talked about in previous videos? Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. These tech giants that have been carrying the market on their shoulders, well, they collectively got crushed on Monday. The biggest loser was Tesla, which plummeted 15%, its worst single-day performance since September 2020. That's a massive drop for a company of Tesla's size. The electric vehicle maker has been under particular pressure lately due to falling sales and growing concerns about Elon Musk's commitment to the company. With Musk juggling SpaceX X, formerly Twitter, and his political activities, some investors are wondering if Tesla is getting the attention it needs from its CEO. But Tesla wasn't alone in its misery. Let me run through the Nasdaq 100's worst performers on Monday. MicroStrategy led the pack with a stunning 16.7% drop. This company has tied its fortunes closely to Bitcoin, so when crypto falls, MicroStrategy often falls harder. Tesla, as I mentioned, dropped 15.4%. AppLovin fell 12%. Microchip Technology tumbled 10.6%. Palantir was down 10.1%. Atlassian dropped 9.6%. Dexcom fell 9.2%. CrowdStrike was down 7.4%. ARM Holdings lost 7.3%. And Marvel Technology also fell 7.3%. That's a lot of double-digit losses in a single day. If you owned any of these stocks, you probably felt some pain. But here's an important question. Is this just a temporary setback or the beginning of something bigger? The Nasdaq has now fallen into what analysts call correction territory, which means it's down more than 10% from its mid-February high. Corrections are normal and healthy in bull markets, but they can also sometimes signal the start of a bear market. What's particularly concerning is that this sell-off isn't just affecting stocks. The anxiety is spreading to other markets as well. Treasury yields are declining as investors flee to safety. The benchmark 10-year Treasury rate is hovering near its lowest level this year. When investors are worried about the future, they often buy government bonds, which pushes yields down. And what about cryptocurrencies? Well, they're not providing much shelter either. Bitcoin, the largest cryptocurrency, fell to nearly $77,000, its lowest price since November. So much for crypto being a hedge against stock market volatility, at least in this case. Now let's take a step back and think about what all this means. A $1 trillion sell-off sounds scary, and it is, but it's important to put it in context. The Nasdaq had an incredible run before this correction. From its low in October 2022 to its peak in February 2025, the index gained about 70%. So even with this recent drop, long-term investors are still sitting on substantial gains. Think of it like this. If your house value went up 70% over 2 years and then dropped 10%, you'd still be up 53% overall. Not too shabby, right? But that doesn't mean we should ignore what's happening. This correction could be signaling a shift in market dynamics. The easy money from the AI boom might be behind us, and investors may need to be more selective going forward. So what should you do as an investor? First, don't panic. Market corrections happen regularly. On average, the market experiences a 10% correction about once a year. If you have a long-term investment horizon, this could actually be an opportunity rather than a disaster. Second, review your portfolio. Are you overexposed to high-flying tech stocks? If the recent volatility is keeping you up at night, it might be time to rebalance and ensure your asset allocation matches your risk tolerance. Third, consider dollar cost averaging. If you believe in the long-term potential of technology companies, buying during dips can lower your average cost basis over time. Fourth, keep some powder dry. Having cash on hand during market corrections gives you the flexibility to take advantage of opportunities when quality stocks go on sale. Let me share a personal perspective here. I've been through several market corrections and bear markets during my investing career. Each time, it felt like the world was ending, but it never did. Markets recovered, often faster than expected. The investors who kept their cool and stuck to their long-term plans generally came out ahead of those who panicked and sold at the bottom. Remember Warren Buffett's famous advice, be fearful when others are greedy and greedy when others are fearful. Right now, fear is definitely in the air. Could this be a buying opportunity for the patient investor? It's something to consider. But let's not sugarcoat things either. There are legitimate concerns about the economy. Inflation has been stubborn, interest rates remain relatively high, and consumer spending is showing signs of weakness. The possibility of a recession is real, and recessions typically aren't kind to stock markets. What's particularly interesting about this sell-off is how concentrated it was in technology stocks. While the Nasdaq fell 3.8%, the Dow Jones Industrial Average, which includes more traditional companies, fell a more modest 1.8%. This suggests that investors aren't abandoning stocks altogether. They're specifically reconsidering their exposure to high-growth, high-valuation tech companies. This brings up an important point about diversification. If your portfolio was heavily weighted toward the Magnificent Seven or other tech stocks, you felt Monday's pain acutely. But if you had a more balanced portfolio that included value stocks, international stocks, bonds, and perhaps some alternative investments, the impact would have been less severe. It's a good reminder of why we often talk about not putting all your eggs in one basket, no matter how attractive that basket might seem. Even the most promising sectors can experience significant volatility. Looking ahead, what should we watch for? Several key indicators will help determine whether this is just a correction or the start of a more prolonged downturn. First, keep an eye on upcoming economic data, especially inflation reports and job numbers. If inflation continues to run hot or employment weakens significantly, that could pressure markets further. Second, watch corporate earnings. Many companies will report their first quarter results in April. These reports will give us valuable insights into how businesses are actually performing amid economic uncertainty. Third, pay attention to the Federal Reserve. The central bank has been hinting at interest rate cuts, but the timing remains uncertain. Rate cuts could provide a boost to stocks, especially if they come sooner rather than later. Fourth, monitor geopolitical developments. Tensions in various parts of the world could exacerbate market volatility. I want to emphasize that market timing is incredibly difficult, even for professional investors. Rather than trying to predict short-term market movements, focus on your long-term financial goals and ensure your investment strategy aligns with those goals. If you're young and saving for retirement decades away, short-term volatility matters less. You might even welcome lower prices as an opportunity to accumulate more shares. But if you're approaching retirement, or already retired, you might want to ensure you have enough conservative investments to weather market storms without having to sell stocks at depressed prices. Let me share a quick case study. During the March 2020 COVID crash, the Nasdaq fell about 30% in just a month. It felt like the end of the world, but by August of that same year, Just 5 months later, the index had not only recovered all its losses but reached new all-time highs. Investors who sold during the panic missed out on one of the most powerful recoveries in market history. I'm not saying the current situation will play out the same way. Every market environment is unique. But history does show that markets have incredible resilience over the long term. Before we wrap up, let's address some potential concerns you might have. Should I sell now to protect myself from further losses? Generally, selling after a significant drop locks in your losses and puts you at risk of missing the recovery. Unless you need the money immediately or your investment thesis has fundamentally changed, staying the course is often the better strategy. Is this the start of a major crash like 2000 or 2008? Nobody knows for sure, but there are important differences. Unlike 2000, many tech companies today have strong earnings and cash flows. Unlike 2008, the banking system is much better capitalized. That said, valuations for some tech stocks have been stretched, which creates vulnerability. Should I buy the dip? If you have a long-term horizon and are investing in quality companies or broad-based index funds, gradually adding to your positions during market weakness can be a sound strategy. Just don't try to catch a falling knife by going all in at once. To sum up, Monday's $1 trillion Nasdaq sell-off was certainly dramatic, but it's important to maintain perspective. Market corrections are normal, even in healthy bull markets. While there are legitimate concerns about the economy and tech valuations, long-term investors have historically been rewarded for patience and discipline. My actionable advice: review your portfolio, ensure your asset allocation matches your risk tolerance and time horizon, and consider whether this volatility presents opportunities rather than just threats. And most importantly, don't let short-term market movements derail your long-term financial plan. If you found this analysis helpful, please hit that like button and subscribe for more insights on navigating market volatility. In my next video, I'll be diving into specific sectors that might offer better shelter during economic uncertainty. So make sure you're subscribed so you don't miss it. This is Iggy from the Investing Iguana, reminding you that successful investing is a marathon, not a sprint. Thanks for watching, and I'll see you in the next video.